Welcome to Iron Financial. This is the forge where we build stronger portfolios by stress testing market narratives until they either break or prove their strength. And today, we are putting Lumexa Imaging, that's ticker LMRI, right on the anvil. You know, this is a classic battleground stock. The share price has just been pulverized, hammered down to near 52-week lows. It really suggests a structure that's on the verge of complete collapse. And yet, you look at Wall Street, the analysts covering this company are practically all shouting strong buy. So that creates the fundamental question we have to answer here today. Is Lumexa a deep value opportunity that's been forged in fire, or is it just a classic value trap waiting to snap shut on unsuspecting investors? All right, let's get to work.
Okay, so this slide right here, this frames the entire conflict perfectly. On the left side, you've got the market's raw, emotional verdict. The stock is in the basement, plain and simple. And they just reported a truly catastrophic fourth quarter earnings miss. They swung from an expected profit to a 66-cent loss per share. That is the hard evidence the bears are trading on.
And then you look at the right. This is the institutional view, the so-called professional analyst community. They are just pounding the table on this thing. A strong buy consensus. Their median price target, $23. That implies more than 110% upside from where we are right now. So you've got one side seeing a building that's been condemned, while the other side sees a skyscraper being sold for basically the price of its foundation. It's really hard to imagine a wider disagreement than what we're seeing here.
And that really is the central question of our entire analysis today. When you have the market's price action and the street's expert opinion in a head-on collision like this, well, one of them has to be catastrophically wrong. So is the market, the so-called wisdom of the crowd, is it seeing some kind of fatal structural flaw that all the fancy spreadsheets and models are missing? Or are the analysts, with their direct lines to management and their deep dive forensics, are they seeing a durable, powerful business that's just buried under some temporary rubble? Someone is dead wrong. Our job is to figure out who. Okay, so I'm going to start by arguing for the market. Because let's be honest, when a stock gets punished this severely, it's not by accident. There are usually some very, very good reasons. The headline numbers, they look weak. The underlying financials, at least on the surface, they look even weaker. And look, we're not talking about minor cosmetic issues here. We're talking about what look like deep foundational cracks in the facade. So let's start hammering on these points and see if this whole structure actually holds up.
Let's begin with the most recent and frankly the most alarming piece of data, that Q4 earnings report. The expectation, the promise they made to Wall Street, was a modest little profit of 7 cents per share. Okay, the reality they actually delivered was a loss of 66 cents. That is a 73-cent miss. This isn't a rounding error. It's not a slight miscalculation. This is a fundamental breakdown in execution and forecasting, you name it, for any company, but especially for one that just recently came to the public markets and really needs to build credibility. A miss of this magnitude is a 5-alarm fire. It makes you immediately question if management even has a firm grip on the controls of their own business.
And don't for a second think that quarterly loss was just some kind of one-off event. Oh no, it's just one piece of a much larger, much more troubling pattern. For the entire fiscal year of 2025, Lumexa posted a GAAP net loss of more than $47 million. Let's be perfectly clear about what this number is. This is the official, audited, bottom-line result according to generally accepted accounting principles. This isn't some fuzzy adjusted metric we can debate. It means the company is, officially, losing a tremendous amount of money. How can anyone argue for a strong foundation when the business is bleeding nearly $50 million a year? Now, let's actually inspect that foundation itself. The debt-to-equity ratio, it stands at a breathtaking 7.86. Now, to give you some context here, most conservative investors, they start to get really nervous when this ratio climbs above 2. Lumexa is carrying a debt load that's almost 8 times greater than its shareholder equity. That is an enormous weight sitting on the balance sheet. In a calm, stable economic environment, maybe, just maybe, it's manageable. But in a world with volatile interest rates or any kind of operational stumble, a debt burden like this becomes a boat anchor. It gives you absolutely zero margin for error, and it can drag a company straight to the bottom fast.
And believe it or not, the story gets even worse when we look at the core engine of the business, its profitability. Just look at these margins. The operating margin is negative 3.4%. So what that means is for every $100 of business they do, they lose $3.40 just running their basic operations. And that's before they even pay a dime of interest on that massive debt pile we just talked about. The net margin is even deeper in the red at negative 10.1%. And the return on equity, a disastrous negative 15%.
This paints a very, very clear picture. This is a business that is fundamentally inefficient. It's not just unprofitable, it is actively destroying shareholder value with every single quarter that passes. And finally, let's talk about a major threat that is completely outside of management's control. Global helium prices are surging, and that's due to all sorts of supply chain disruptions. Now, why is this so critical? Well, helium is an absolutely essential component for cooling the magnets in MRI machines, which, by the way, are the high-margin heart of Lumexa's entire business. So even if they could miraculously fix all their internal financial issues tomorrow, this external pressure threatens to squeeze the profitability of their most important service. It's a significant headwind that could undermine any turnaround attempt before it even gets started. From the market's point of view, this entire structure just looks dangerously unstable.
Okay, that's a powerful bear case. You've laid out the surface cracks, the chipped paint, the visible rust, and the market is reacting to exactly that, all the superficial damage. But here at Iron Financial, that's where our work really begins. We don't just look at the facade. We bring out the heavy equipment to stress test the underlying structure, the steel foundation itself. Because what the market is missing, and what those analysts clearly see, is that beneath all these surface-level problems lies a core of incredible strength. It's time to test that steel.
First things first, let's just demolish this idea that this is a failing business. Failing businesses do not grow. Lumexa is growing, period. Look at the top line. Total consolidated revenues climbed from just under $950 million in 2024 to over $1 billion in 2025. That's a 7.8% increase. This is the first and most fundamental piece of evidence. Demand for their services is not shrinking, it is expanding. This is the bedrock of the entire bull case. You just cannot have a collapsing structure when your footprint is actively getting bigger and stronger year after year. But it's the quality of this growth that really matters. It's not just any growth. We're talking about high-margin, high-quality growth. So system-wide revenue was up 8.2% for the year. Great, but you have to dig deeper. The most important metric here is same-center advanced volume growth. That's the high-value stuff like MRIs and CT scans in their established centers. That number was up a massive 12.7% in the fourth quarter alone. For the full year, it was up 8%. This shows us the core business is getting more profitable, not just bigger. And on top of all that, they're planting the seeds for future expansion, opening a record 9 new centers in 2025. This isn't random. This is the blueprint of a powerful, strategic expansion.
All right, let's address that ugly GAAP net loss that you highlighted. You're right, the number is bad. But for a company that's in a heavy investment cycle, one that's dealing with all sorts of IPO-related costs and debt restructuring, GAAP income is an extremely misleading metric. It just is. The superior measure of core operational health is adjusted EBITDA. And on that front, the story is the complete opposite of what the bears are telling you. Adjusted EBITDA grew from about $200 million in 2024 to over $230 million in 2025. That is a 14.6% increase. This metric shows you the raw cash-generating power of the business, and that power is growing at a double-digit rate. The engine is getting stronger, not weaker.
Okay, analyst, I'll grant you the growth in the adjusted profitability, but you can't just brush past that mountain of debt. A 7.86 debt-to-equity ratio, that looks like a fatal weakness in the foundation. I don't care how you slice it. It does, if you're only looking in the rearview mirror. The crucial point here isn't where the debt was, but where it's going. In 2025, management executed a massive 2-turn reduction in leverage. Now, that is a huge step in reinforcing the balance sheet. And this isn't just some accounting entry on a spreadsheet. This deleveraging saves the company over $50 million in cash interest payments annually. That's $50 million in cash flow they can now redirect into growing the business. They identified a weak point in their structure, and they have been aggressively fortifying it.
So, we've established a pretty solid foundation here, right? We've got robust top-line growth, accelerating high-margin procedure volume, double-digit adjusted EBITDA growth, and a rapidly strengthening balance sheet. That covers the present. But the real reason analysts are so bullish on this thing is because of the future. Management has laid out a crystal-clear blueprint for 2026, and it signals a major inflection point. Let's examine that blueprint to see how it builds on the strength we've already identified.
And here it is, the 2026 forecast, straight from the company itself. Step 1, continued revenue growth, pushing even deeper into that billion-dollar-plus territory. Step 2, continued adjusted EBITDA growth with a midpoint of around $238 million. But Step 3 is the absolute game changer. They are forecasting positive adjusted earnings per share between 71 and 77 cents. This is the pivot. They are officially signaling the end of that heavy investment phase and the beginning of a new era of sustained, recognized profitability. The market has been waiting for this, and management is telling you point blank it's coming this year.
Whoa, hold on a second. That adjusted EBITDA growth is slowing way down. You just celebrated 14.6% growth in 2025, but the guidance for 2026, if you take the midpoint, is only about 4% growth. That looks like a major deceleration to me. That is an excellent catch, and it's something you have to dig into the details to really understand. This brilliantly illustrates why context is everything. That 2026 guidance is absorbing about $7 million in new, ongoing costs just related to being a public company that weren't there in 2025. So if you adjust for those costs to get a true apples-to-apples comparison of the core business, the underlying growth rate is actually a very healthy 7%. So while the headline number looks slower, the core operational engine is still firing on all cylinders.
And look, this isn't just our interpretation. This is the explicit message coming straight from the CEO. Caitlin Zula said, "We believe Lumexa Imaging is well-positioned to deliver sustained, profitable growth." The key words there are sustained and profitable. This is a confident declaration from leadership. They are telling the market that the heavy lifting is done. They've built the machine, now it's time to run it for profit and deliver that value back to the shareholders.
So, we've built a strong bull case based on the operations and the guidance. But there's one final layer to this, and it is arguably the most critical piece of the entire thesis. It explains the massive disconnect between that beaten-down stock price and those bullish analyst targets. You see, the market is valuing Lumexa with a standard toolkit, and it's just the wrong one for the job. To see the true value here, you need a specialized tool. You need what's called a sum of the parts analysis.
So what is a sum of the parts, or SOTP, valuation? Well, simply put, it's a way of looking at a company not as a single entity, but as a kind of holding company for several different businesses. You analyze and you value each business segment on its own terms, using whatever metric makes the most sense for that specific segment. Then you just add them all together. It's especially useful for a company like Lumexa, which has these distinct divisions with very different financial profiles. It prevents one part of the business from unfairly hiding the value of another.
And here is what that analysis actually looks like in practice. This is the conservative model from the analysts over at Raymond James. They've split Lumexa into its two core businesses. First, you've got the joint ventures. These things are highly profitable, cash-gushing partnerships, so they valued this segment based on its after-tax cash flow of $58 million, and they apply a 15x multiple to it. That alone gets you an equity value of $870 million. Second, you have the wholly owned consolidated centers. They value this segment using its adjusted EBITDA of $145 million and a 10x multiple, which translates to about $642 million in equity value.
So when you add those two pieces together, the total conservative fair value comes to roughly $1.51 billion.
And the company's current market capitalization is only about $1.03 billion. So even using this conservative model, you're looking at an implied upside of 46% from today's beaten-down price. That's a huge disconnect.
Precisely. And remember, Raymond James calls this their conservative case. Their base case is even higher. What this analysis argues is that the market is making a fundamental error. It's allowing the less profitable consolidated business to completely obscure the massive value of the joint venture segment. The true value is hidden in plain sight. So, that brings us to the moment of truth. We've examined the cracks in the facade through the lens of the bear case. We've stress-tested the steel foundation with the bull case. We've reviewed the blueprint for 2026, and we've used a specialized tool to uncover what looks like hidden value. Now, it's time to weigh all the evidence and forge our final, actionable verdict here at IRT Financial. Okay, I have to admit, the bull case is structurally sound. The focus on adjusted EBITDA, the aggressive deleveraging, and especially that sum of the parts analysis, it really does completely reframe the narrative. Now, the risks from the debt and external factors like helium prices are still real. You can't just ignore them. But the quality of the growth and that clear path to adjusted profitability, it suggests the market's pessimism is extreme.
The risks are noted, and they absolutely must be managed. But our verdict is clear. We believe this is a structure that is built to last. The market is fixated on the headline gap losses and the historical debt load, all the superficial damage. It is completely missing the underlying strength of a growing cash flow positive core business and the immense mispriced value of that joint venture segment. In our view, this has created a deep value opportunity.
So we'll leave you with this final thought. This company is at a clear inflection point. It is pivoting from a period of heavy investment to a new phase of sustained, profitable growth. The numbers are improving, the balance sheet is getting stronger, and the path forward is clear. So the question you have to ask yourself is this: will you be positioned to capitalize when the rest of the market finally stops staring at the headlines and starts looking at the strong foundation that's been built underneath? That's all for this edition of Iron Financial. Stay strong.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.